Hi, my name is Ryan Bundy. I'm with NFM Lending, and I'm here to explain to you about the different loan programs that you've probably heard out there as a buyer. We're going to talk about conventional loans, we're going to talk about FHA loans, VA loans, and jumbo loans. So before we get into this, I'm new to YouTube. This is my first long form. You can see that I do a lot of short form. Please subscribe, support us. We do a lot of podcasts, and I'm just here to help you with your mortgage experience. So let's go jump into conventional loans. Conventional loans are the norm, conventional. People use these, generally 20% down, you've heard, but you can do as little as 3% down on a conventional loan. I'll explain that later. So conventional loans generally have a little bit better credit. They start at 780 credit score, and then there's incremental pricing every 20 points. So 780, 760, 740, 720, 700, 680. So, when you're getting pricing, it's more sensitive on these conventional loans to your credit score. Not so much about the down payment, because you're gonna have mortgage insurance. You've heard about mortgage insurance. So if you don't put 20% down on a conventional loan, you're gonna have mortgage insurance. But here's the good thing. Every 5% down increment, it's gonna be less mortgage insurance. So it's a less rate on your mortgage insurance, plus your loan amount's gonna be lower as you put more down, so that payment's gonna be lower as well. There's actually a percentage of your loan amount. So for example, if you put 5% down, your rate will be the same as a 20% down, but you're gonna have mortgage insurance. Let's just say hypothetically, if you have really good credit, your mortgage insurance rate would be like, let's say 0.4%. So your interest rate plus 0.4%. It's kind of an effective interest rate with your mortgage insurance. If you do 10% down, that percentage is going to drop. And you put 5% down, it's going to drop significantly. So the mortgage insurance, as you put more money down, it's less risk for the lender and you're going to pay less. So just important to remember that. Why would you do a conventional loan versus an FHA loan? Maybe if you have, let's say 3% down. So a lot of people don't understand. You can put 3% down if you're a first-time home buyer on a conventional loan. The other way you can do 3% down if you're not a first-time home buyer is if your income is 80% of your area's median income. So let's say your median income in your county is $100,000. If you make under $80,000, you can do 3% down, and you actually get a break on your interest rate with that program, and you get a break on your mortgage insurance program. So that's more income driven. If it's just 3% down on a first time home buyer and you make more than 80% of the median income, then you're just gonna have a little bit higher terms on that. So I'd be able to walk you through that to see if it makes sense, to put 5% down or even look at an FHA loan. So conventional loans, solid credit, solid payment history, low debt ratio. You can go to about 50% of your gross income combined, all of your debt, including your mortgage, taxes and insurance, and PMI, mortgage insurance, everything included. You can go to about 50%. So if you fit those parameters, we always try to get you into a conventional loan. I get a lot of questions on conventional loans. How can I get my mortgage insurance removed? So several ways. When you pay the mortgage down to 20% equity, you can call a loan servicer and get it removed. If let's say that the value increases and you want to get an appraisal, you need 25% equity. The reason why is because values of homes fluctuate, right? So they want to make sure that if you're going to base it off of the new value, they want 25% equity in that situation. So conventional loans, good credit, no bankruptcies, no foreclosures in the last 7 years, good payment history, higher credit scores. Definitely, you could do conventional loans with lower credit score, but your rate is gonna be affected significantly. So that leads us into FHA loans. FHA loans are backed by the government, Federal Housing Administration. This program was started during the Great Depression to stimulate home ownership for people who might have run into problems in the past with their credit. So I actually put people with good credit sometimes into an FHA loan, depending on their credit score. They could have a 720, 700 credit score, but very low down. Sometimes it makes sense. I'll tell you why soon. FHA, the reason why generally somebody would do an FHA loan is if they had some trouble with credit. So lower credit score. You can go down to a 580 credit score on FHA loans. So if you had a bankruptcy in the last several years, you had foreclosures, late payments on things, collection accounts, stuff like that, we can take a look at that and see if that fits for FHA. The cool thing about FHA loans is they're not as sensitive to credit score for the interest rate. So if you have a 700 credit score versus a 650 credit score, your interest rate's not gonna be super affected like a conventional loan. But what they do is they have mortgage insurance on there, and that mortgage insurance, it's 0.55% of your loan amount. So your interest rate plus the 0.55 for the mortgage insurance. Now that never goes away. It never drops off, but kind of okay because your interest rate on an FHA loan is significantly less generally than a conventional loan. Another downside of an FHA loan is they have an upfront mortgage insurance premium. So that is financed into your loan. It's 1.75% of your loan amount. So if you have a $500,000 loan, do the math on that. It's just tacked on to the balance of your loan. You don't have to pay it in cash. So it just adds to your loan balance, and I have spreadsheets that can show you if it makes sense. But the cool thing about FHA is it opens the door to people and gives them a second chance. Maybe they went through a divorce. Maybe you had a foreclosure. Maybe you got sick and lost your job or got laid off. And this allows you, with a lower credit score to get really good terms on a mortgage and get into a house as long as you meet the standards. So 580 credit score. Another thing I want to talk about on the debt ratio is the debt ratio is a lot higher to qualify on an FHA loan versus a conventional. So conventional, you have to be under 50% of your gross income for all of your debt, including your mortgage stuff. On an FHA loan, it can go to like 56%. So if you have a lot of debt, maybe some student loans and situations like that, then they're going to be a little bit more lenient with that. So any questions on the FHA in your situation, I'm happy to take a look. You can put the comments below. So let's move on to VA loans. So VA loans, probably the best loan you can get is for veterans or active duty members. You can be in the reserves if you meet a certain criteria, which we'd have to take a look, but that offers 100% financing with no mortgage insurance. It's an amazing loan, and the rates are like FHA rates. So they're low rate, no mortgage insurance, and up to 100% financing. So also very lenient, go down to below 580 credit score, and they're just very forgiving with collections, late payments, stuff like that. It's an awesome loan. I'm gonna do a separate video on VA loans because it's not for everybody, but I wanted to, if you've heard of these in the market, if you're not a veteran or active duty or been in the reserves for a certain amount of time, it's not really applicable. So let's go into jumbo loans. Get this a lot. If you're in King County, high-priced areas, jumbo loans are a big deal. So conventional loan limits. Conventional loan limits are $766,000 nationwide. So anything above that, your loan amount, not the purchase price, but the loan amount, if it's above that, it's considered a jumbo loan. So things get really tight. Fannie Mae and Freddie Mac, like we talked about, they don't back those loans. These are generally backed by the big banks and big investors, private equity firms, stuff like that. So they make their own rules, and each investor has different rules. So it just depends on your specific situation, how you fit. We have to take your application, try to get you the best rate possible. But the guidelines are very strict. No bankruptcies, no foreclosures in the last 7 years at least, higher credit scores. They really hammer you on interest rate if you have below every 20, like we talked about on the conventional loan, they're gonna be even stiffer on that pricing. So these are almost always 20% down. We have lower down payment, but you're gonna pay 10% down, 15% down. These come and go with market. So when the market's shaky and like you hear in the news, there's things going on in the economy, they pull back. So 20% down, sometimes 25% down. And then when things loosen up a little bit, things start flowing, they bring back that 10% down program, 15% down program. But it's very market driven, appetite driven by the investor. So guidelines are gonna be, debt ratio is a lot more strict, 43%, 40% versus the 50%. And they're gonna look at your income, credit history a lot closer. Conventional and FHA loans and VA loans are automated approvals. So Fannie Mae and Freddie Mac have systems. We all use them as lenders. We take your application, we run it through their automated system, and it tells us if it's approved. With jumbo loans, it's manual. So you have to look at their guidelines, and then underwriter has to manually do everything. So we like to do that in front. We like to take your application on pre-approval, send it to the underwriter, make sure everything's dialed in, then we issue the pre-approval. It's a little bit more work. We've done many of them. It's not that big of a deal, but I just want to put that out there that things definitely get tighter. So one other thing I want to go into in higher priced areas, if you're watching this, I'm in the Seattle area. I'm all over Washington, Oregon, but basically we do a lot of business in Seattle, King County, Pierce County, Snohomish County. They bump up, since it's high priced, they go over 766,000 is the national limit. In those counties, it's actually 977,000. It's called a high balance conforming loan. So it's a non-jumbo loan. So the cool thing is you can do 5% down and have a loan of 977,000. So just over $1 million price, you can do 5% down. It's a really good deal. So that's about it for now. If you have any questions, please put in the notes below. I'll get back to you. And if you ever have any questions, reach out to us, okay? Thanks for listening.